Hey everybody, welcome back to Mining Stock Daily. We have some market analysis here to most likely finish out our day, and it's been a very eventful day, actually a very eventful week. And so who better to welcome in to kind of help us make sense of all this than the author of the Boock report, Mr. Peter Boockvar. Peter, welcome back to the podcast. It's been a little bit.
Thanks, Trevor. Appreciate having me.
Yeah, listen, it really seems the focal point of the economic discussion this week is really what's going on with bond yields. And we've had a couple auctions this week, but before we kind of get into some of the nitty gritty that you saw in those auctions, talk to us about this implication we are seeing now of the higher for longer narrative that is really taking hold.
Well, I think that sort of replaces the when's the Fed going to be done raising interest rates. So it's not when are they done, it's because they're pretty much done. It's how long are they going to keep rates around these levels? And I think that's the real question. But even if they start to cut next year, it's the days of like going back to zero for a while, that's over for a while. The days of massive QE are over for a while. I say for a while because obviously the central bank can always do anything again. But I think that Powell's very afraid of repeating the upside waves of inflation in the 70s after the downsides that we saw, and that's why he's going to keep money tight for a while. And it's not just keeping rates higher for a while, particularly relative to the rate of inflation. So while they may cut, that will be sort of coinciding with any further drop in inflation, but real rates are going to stay firmly positive and not something that we've seen in at least 15, 16 years. In addition to QT is still ongoing. And, it's amazing how excited people get over QE and somehow QT is just not a big deal. But I think it is a big deal. The Fed's balance sheet has gotten below where it was when they bailed out a lot of the banks in March. And that acceleration to the downside, I think will at some point pick up some more attention.
We've seen that acceleration. If there is an acceleration of the downside, we could probably go back and link it to the last couple of weeks with the Fitch downgrade and then also Moody's downgrading the debt of 10 well-known banks, I guess you say. Do you think we'll go back? I mean, is that something we'll go back in time and be like, that really was those downgrades was the time where the market really started to turn over? Because before then, the market was trying to call the Fed's bluff here and expect a reversal.
Well, the bank downgrades really didn't tell us anything new that we didn't already know. So sure. I don't think that there was really any new information. What I did do, though, is highlight the challenges that these banks currently have in terms of profitability, tighter lending margins because of higher deposit costs, risks to their commercial real estate books. So if people forgot what happened in March, this certainly was a reminder. I think the big event over the past couple of weeks with respect to the U.S. bond market was the Bank of Japan widening yield curve control. The Bank of Japan was essentially the author of zero rates and QE, and they are now sort of bookending the tightening we've seen throughout all central banks except the Bank of Japan, outside of one yield YCC tweak last year when they went from 25 to 50 basis points. So it's no coincidence that yields around the world rose right after the Bank of Japan did that. And I think that that's still a very big deal in terms of its influence on global bond markets, on top of course, the more heightened attention that investors have to the ever-rising U.S. debts and deficits that never mattered to markets for many decades. Going back to the mid-'80s, people were complaining about the widening U.S. budget deficit. But now the numbers are getting so large. Now you have a budget deficit relative to GDP at about 7%, even before a recession takes hold, that the numbers get rather alarming. At the same time, the Fed is essentially selling treasuries via QT. We have foreign central banks that have turn their head to U.S. Treasuries, and banks are already loaded up with them already, and they're just not going to be that same marginal buyer like they were in 2020 and 2021. and 20.
Interest payments on U.S. debts reaching $1 trillion. Is that more of is that a line in the sand, or more just kind of a scary boogeyman number out there for people to clinch onto?
Well, for now, it's just a large round number. We have to look at that interest expense relative to the revenue the government takes in.
Hmm.
It's trying to figure out what line item matters with respect to the government deficit in terms of its influence on the dollar or rates. It's difficult to say because, again, no one's cared for all these decades. But I think we're reaching a point where more people do care, but just trying to figure out how it's going to sort of filter its way into the markets, particularly the Treasury market and I believe the FX markets. We're just going to have to wait and see.
With the data that you're seeing, and also looking at the movement in bond yields, Peter, I've had a number of conversations the last couple of weeks. I'm still yet to make a decision whether I'm bullish or bearish bonds. I get both sides. Hopefully you can shine some light on me about how you are approaching the bond market. Do you lean more bearish or bullish, or vice versa?
Well, I'm pretty bullish on short-term bonds because I think the Fed's just about done raising rates. So I'd be, us as a firm, we buy a lot of short-term treasuries in particular, in addition to other short duration fixed income. I think we've shied away from taking real duration risk. I can make the argument that the 10-year yield, if one were just to analyze the trajectory of U.S. inflation and growth, yeah, I can argue that the 10-year should go to 3.5. But for not good reason, I can easily argue and I think it's actually going to have be more likely that the 10-year goes to 4.5 or more. And that's because
Mm.
of the reason stated earlier about the Bank of Japan losing control of their bond market. ECB, as the months progress, is getting deeper into QT, in addition to us doing QT and the Bank of Canada doing QT and the Bank of England doing QT and so on. Uh, in addition to, yes, again, I'll say the rising U.S. debts and deficits and just trying to find enough buyers for all this massive paper. Now, there are natural buyers that are stepping up for the first time in 16 years, the last time rates were at these levels, and that's the U.S. private sector. That's individuals who are saying, wow, I'll buy 5% T-bills all day, or pension funds and insurance companies that finally have some yield to be had. So there is some natural buying from there. I just think that it's much more uncertain what that inevitable clearing price is going to be in long duration paper, and I just don't find the reward enough relative to the risk. So rather than saying, okay, this is where I think the 10 year is going to go, trying to game out a range of potential outcomes. And to me, there's just much more risk going out duration wise relative to the gift that we're getting out to maybe even 3 years.
Yeah. I was in my local bank. I still go to a bank once in a while, and I saw it was a Chase Bank, and they were for $100,000 you can buy a 6 month CD for 5%, and that was on the board right above the counter. I actually looked at that. I was like, that's pretty damn good. Like I couldn't believe it, and I've heard other people say they've seen some other instruments out there that were yielding up to 20% in places. I mean, is this really, this has got to be where it's going, but some of the big banks savings accounts are still like 0.2%. So where's the lag here between, in that fixed income industry? I mean, I will admit I'm completely naive and need to learn a lot more of this, but how can you have such variables here, Peter, between big bank savings accounts and that fixed income uh,
Well, I
avenue?
mean, banks are saying, hey, you're willing, you're free to take your money if you want and put it in a higher yielding certificate of deposit or a treasury or wherever you want. If you want it, take it. Uh, and that's why the banks are offering those different products. But in terms of the 0.01% yield on a savings rate, yeah, it's an insult to the rest of us that the banks sort of force us to go through all these different exercises of trying to find the higher yield. But until there's a mass exodus out of those savings accounts, the
Mm,
banks will try to get away with as much as they can, not having to raise it because they know it squeezes their margins and they may not be able to make it up on the back end because the back end being what a small business would get charged, for example, is already very high. The cost of capital for most of corporate America outside of the best credits is 8 to 12%. And, that's double or more what it was before the Fed started raising interest rates. So that's a different game. And I think it's just about, trying to protect their margins that's created this widespread.
Yeah. Switching gears here, you published a new blog on the Boock report about ZipRecruiter, and I actually read this. I think it was last night, some of the highlights, and then you ended up writing about it. But this was really telling. It was interesting because you never, like, when you think of the labor department, I guess I never think of ZipRecruiter anymore. I kind of find it, mundane and outdated. But there was some really interesting data points out of ZipRecruiter. Kind of open that up for us and learn what you shared.
I mean,
Or share what you learned.
Yeah. So for the third quarter in a row, ZipRecruiter, which is an online recruiter where employers pay them to view potential job seekers. The employer pays ZipRecruiter in a few different ways. They have a choice of where this job seeker can go on for free and look to see what's available. But it's a great tell on the pace of hirings. Not the pace of firings, but the pace of hirings. And for the third quarter in a row, ZipRecruiter is citing slower demand for hiring. Now, we try to square that with a lot of the other job stats, whether it's the monthly payroll report or jobless claims or whatever. Now, I have a feeling that when all is said and done, when the BLS finally revises for the last time all of these monthly payroll reports for 2023 that have been fluffed by this birth death model, which estimates the amount of new companies relative to the amount of lost companies, that a lot of these job gains were overinflated, and that ZipRecruiter is going to be correct in citing this notable slowdown in the pace of hiring. Now, with respect to initial jobless claims, which is measuring the pace of firings, that remains relatively muted. And you can still have both because companies that had a tough time finding people over the last couple of years, they're going to hold on tight. They're going to be reluctant to get rid of them. And also when you think about the first natural reaction of a company, when things slow down or there's macro uncertainty where you just want to call a timeout on capital spending and expansion, well, you just say, okay, let's just be a little bit more judicious with the pace of hiring. You don't start firing people, you slow down the pace of hiring. And I think that's what we're seeing now. And I think that we can't, now, while ZipRecruiter is sort of just an anecdote, it's not in the so-called hard data yet. Like I said, I think we're going to look back and say that, ZipRecruiter was right. And these BLS numbers are going to, a lot of the birth death additions are going to get revised away, and the job growth in 2023 is going to be more muted than it was initially reported.
I would be disappointed if I didn't ask you about the CPI print coming out tomorrow morning. I think expectations are it's maybe a little bit of an uptick. How much of an uptick from last month is yet to be seen. Expectations, what do you expect to see out of CPI and how market responds?
Well, the uptick will definitely be mostly energy related. I mean, gasoline prices just in the month of July are up about 7% and have continued that rise into the early part of August. So that'll explain the headline. I think trying to figure out core has gotten more difficult because of how CPI is measuring the rental component. In real life, rents are growing on a blended basis between new leases and renewals at about 3 to 4% if you listen to a lot of the large publicly traded multifamily landlords. Whereas CPI is still calculating 8% year-over-year rent growth. So the CPI calculation will continue to fall to match up with reality. It's just been more difficult to try to figure out over how many months or quarters that sort of reflection is going to take place.
Yeah. Man, head on a swivel right now. It's been an interesting time for the last 3 years. It's pretty interesting. I've started Neil Howe's Fourth Turning book, the new one, and what a time for that book to be published right now, because it's a head scratcher and everything makes sense. But
the Jesus out of everybody.
Yeah, enough. It's I don't recommend reading it right before bed, but somehow that's what I do. Peter, thanks so much for your time. We'll connect with you again the next couple of weeks or months. Be well, my friend.
Thanks, Trevor. You too.